Welcome to the Research Desk.
Thank you. Let's get right into it.
It is March 17th, 2026, and we are looking at a market architecture right now that is defined by a severe, frankly, historical, structural dilemma.
It really is.
Imagine owning the absolute best business on the planet. I mean, a company printing billions in free cash flow, actively building the foundational infrastructure of the entire artificial intelligence revolution, and watching that exact same company actively destroy your portfolio's quarterly performance.
Yeah, the paradoxes of the current regime.
Exactly. That is the exact paradox we are facing today. Concentrated holders of U.S. megacap technology are facing a tape where the best AI businesses are, well, they're no longer behaving like the best stocks. We are operating in a regime where fundamental dominance has explicitly decoupled from technical reality. For sophisticated capital, the mandate has forcefully shifted.
Precisely. Because these companies have transitioned from being undeniable secular compounders into, frankly, badly structured stocks. They are fraught with what we identify here as digital monoculture risks.
Right.
And if you are managing concentrated exposure today, doing nothing is no longer a neutral stance. It is an active, aggressive, and highly dangerous bet. You are being forced by the market structure to make a definitive choice. You either pay for increasingly expensive and inefficient insurance, or you actively cut your exposure to reduce the risk footprint, or, and this is the hardest pill to swallow, you accept the mathematical reality that cash has become the absolute cleanest hedge in the portfolio.
Exactly. So to navigate this environment, today's briefing will dissect the anatomy of this market divergence. We will establish the indisputable facts regarding both the fundamental power of these companies and the broken tape they currently trade on.
We have to look at both sides.
Right. We will examine the secular bull case, the median outcome of holding through volatility, against the structural bear case, which isolates the severe left-tail downside risks inherent in digital concentration. We'll define the true wildcard in this market, which is the discontinuous trust shock.
The thing that actually breaks the models.
Exactly. And we will conclude with exact basis point level portfolio construction arithmetic. Every threshold, every trigger, and every allocation shift required to survive this regime will be detailed.
Nothing vague, just the exact numbers.
Right. So let's start with the fundamental anchor of this market, which remains formidable. The data is unequivocal. We are witnessing an infrastructure build-out that has no historical parallel in its velocity, its scale, or its capital intensity. The secular dominance of these platforms is written explicitly into their capital expenditure signatures.
The forward commitments are staggering.
They really are. Look at the numbers. Alphabet is deploying roughly $91 billion in AI-related Capex. Amazon is deploying $132 billion. Microsoft is deploying $65 billion. And we have to understand what those numbers represent.
It's not R&D.
Exactly. It's not speculative research and development. This is not software engineering overhead. These are the physical spending signatures of entrenched monopolies hardening their moats, right? They are buying land. They're securing dedicated power grids, acquiring compute clusters, and locking up the foundational models that will dictate enterprise software distribution for the next decade.
Yeah.
The sheer gravitational pull of these balance sheets should, according to any traditional valuation framework, stabilize their equities.
Well, according to a traditional valuation framework, yes. But the tape reality tells a completely different story. And as we know, the tape is where portfolios are actually priced and where risk managers are actually fired.
Fair point.
Let us look at the specific basket. Apple, Alphabet, Microsoft, NVIDIA, Meta, and Amazon. Despite that monumental capital expenditure you just outlined, these names currently sit roughly 11% to 27% below their all-time highs.
It's a massive drawdown for companies with that much cash flow.
It is. The breadth beneath the surface has severely deteriorated. When we look at the trend architecture of the broader market, 4 of the 6 primary trend signals we track are firmly closed.
Right.
And we need to be very precise about what is happening to momentum here. Momentum is not just stalling, it is stuck at what quantitative models define as geometric order zero.
Explain that for a second, the geometric order zero part.
Sure. For those managing risk models, Geometric order zero essentially means the asset has lost its memory. The stock is exhibiting a pure random walk. Yesterday's upward price action no longer has any predictive power for tomorrow's gain.
Wow.
Yeah. The momentum factor, which, let's remember, drove trillions of dollars of systematic flows into these exact names over the last 3 years, has essentially flatlined. The technical disconnect is screaming at us that fundamental power, those massive Capex budgets, is no longer insulating the equity structure from systematic liquidation.
Which raises the exact strategic implication we have to frame for our allegations today. When secular winners with ironclad fundamentals stop trending, how does the mandate shift?
That is the core question.
Right, because historically, over the last decade of quantitative easing and zero interest rates, the focus has always been on maximizing upside capture. You bought the dip because the trend invariably resumed. Now the math dictates a mandatory pivot toward managing asymmetry.
Completely agree.
But before we debate the mechanics of that divergence, we really must establish the undisputed facts of the current market structure. There is common ground here that both the median outcome bulls and the left-tail bears absolutely must acknowledge.
There are 3 distinct agreements we need to anchor on right now.
Right, go ahead.
First, we are not dealing with a simplistic AI bubble versus AI bust scenario. This is not the late 1990s where companies are trading on eyeballs and completely fictitious unit economics.
Pit.com.
Exactly. The operating businesses here are exceptionally strong. The hyperscalers are spending at a scale that only deeply entrenched winners can sustain, funded entirely by their own massive free cash flow generation. The long-term AI build-out is a physical and economic reality. AI is being integrated into every layer of enterprise software, and the efficiency gains are measurable.
I agree completely with that first premise. The businesses are spectacular. What's the second?
The second agreement, and this is where the structural friction really begins, is that the market structure surrounding those excellent fundamentals has drastically worsened. These names are no longer just technology companies. They serve an entirely different, highly leveraged function in the modern financial ecosystem.
They are collateral.
Yes, they are collateral for portfolio confidence. Because they dominate the major indices, they have become the universal, crowded consensus positions for both active and passive management.
Right, everyone owns them.
Everyone. And when you hold a position purely because it feels safe, and literally everyone else is doing the exact same thing, you create a fragile equilibrium. When market breadth breaks across this specific basket, concentration risk manifests physically in portfolios. It stops being a theoretical academic warning found in a risk management textbook and becomes a daily, visceral drawdown reality.
I see that.
If 4 of the top 6 components of the S&P 500 are faltering, there is simply no place for a long-only manager to hide.
Which brings us to the third agreement, which is the choice framework itself. In this specific regime, there are only 3 valid options for a portfolio manager.
Just 3.
1, you pay for insurance. You explicitly hedge the downside risk through options or non-correlated assets. 2, you shrink the exposure that requires the insurance, meaning you actively sell down your highest conviction winners.
Which no one wants to do.
Or 3, you accept the volatility because your position size is mathematically tolerable within your broader mandate. That is the only framing that matters. Doing nothing while holding a massive unhedged concentration is dereliction of duty.
It is. And to truly understand why this market structure is so fragile and why holding concentrated positions in great businesses can be so destructive, we really need to look at the exact precedent of Amazon in late 2021. It perfectly illustrates this duality of a fragile platform versus an excellent business. We have to walk through this timeline specifically.
Walk us through it.
On November 10, 2021, Amazon lost roughly $140 billion in market value in a single trading session.
$140 billion in a day?
In a single session. This was triggered by weaker forward guidance regarding labor costs and fulfillment network capacity. It was an operational speed bump. AWS, the core profit engine, remained a superb compounding long-term business, yet the equity was absolutely punished.
Right.
But the critical event, the one that exposed the true structural vulnerability, happened less than a month later. On December 7, 2021, a major AWS outage occurred. It cascaded across multiple availability zones. It took down Netflix, Disney+, Ring security systems, major logistics networks, and a massive swath of the operational internet.
Okay, I see why you emphasize that dual timeline. But let me give you a different perspective on that exact Amazon scenario. Doesn't that dual event actually prove the long-term bull case?
How so?
Think about the mechanics of what happened. Yes, Amazon suffered a violent $140 billion drawdown. Yes, there was a severe operational outage that made global headlines. But Amazon survived both without any structural impairment to its monopoly. The business did not break.
It didn't break, no.
Enterprise customers did not flee AWS for competitors. In fact, many realized they needed to spend more on multi-region redundancy with Amazon. AWS continued to print cash, expand its operating margins, and maintain its oligopoly over cloud infrastructure. The fundamentals entirely overpowered the technical and operational noise. If you held through that volatility, you own the median outcome of secular compounding.
I come at it from a completely different way. You are analyzing the business. I am analyzing the portfolio construction. The lesson of late 2021 is not that Amazon was at risk of bankruptcy. No credible analyst believed Amazon was going to zero. The lesson is entirely about position structure.
Okay.
An excellent business can still act as a dangerous portfolio concentration that destroys near-term investor capital. Let's break down the math. If you were a portfolio manager holding a 15% or 20% position in Amazon during that window, the fact that AWS was structurally sound provided absolutely zero insulation against the volatility that wrecked your quarterly performance.
That is mathematically true.
Your clients do not care that the long-term thesis is intact when their statements show a massive, localized drawdown. The business survived, yes, but highly concentrated, unhedged portfolios did not survive unscathed. Capital was withdrawn, managers were fired.
Right.
The excellence of the underlying business cannot be a shield against the fragility of the position. When you own a crowded asset, the operational hiccup becomes a liquidity event for the stock.
I can see that the volatility was brutal for concentrated holders. However, having established that even the highest quality companies can inflict structural damage on concentrated portfolios, we must now pivot to why mathematically and strategically one might still choose to hold them through this current 11% to 27% turbulence.
Let's hear the bull case.
We need to define it clearly. Why secular AI winners explicitly deserve to be held. We anchor this view in pure equity valuation theory. Securities ultimately are claims on future cash flows. They are tied to expected earnings growth, margin expansion, and return on invested capital. They are not tied to temporary chart damage or short-term momentum factors stalling out at geometric order zero.
But those technicals reflect sentiment.
They reflect short-term sentiment, but I want to reiterate those staggering Capex signatures because they are the key to the valuation model. $91 billion at Alphabet, $132 billion at Amazon, $65 billion at Microsoft. In valuation terms, this level of spending is not a defensive retreat. This is offensive, aggressive moat building.
It's massive capital outlay.
Yes. Giant balance sheets, unparalleled talent density, and existing enterprise distribution networks make concentration in these metacaps a feature, not a bug. They have the unique ability to absorb years of uncertain returns on massive capital expenditures, a luxury their smaller, more nimble competitors simply do not possess. If a startup tries to build a frontier AI model, it goes bankrupt trying to secure compute. If Microsoft does it, they amortize it over their global Office 365 subscriber base.
But the market is currently rejecting the premise that this Capex will yield immediate linear returns. The tape is telling you that the conversion of that $300+ billion of aggregate spending into actual bottom-line profit is becoming economically messy. We are seeing margin compression fears. We are seeing questions about the terminal value of these models if open-source alternatives commoditize the compute layer.
Look, the tape has been wrong on this exact issue before, which is why historical precedent is so vital here. Let us examine the mechanics of the repricing of NVIDIA during the early deep learning wave.
That was a very different era.
It was, but the mechanics are the same. During that specific period, before the massive acceleration in generative AI, NVIDIA frequently looked
technically stretched. It looked vulnerable to any conventional risk model. The multiples seemed absurd for a company that the market still viewed as a gaming and cyclical semiconductor manufacturer.
Right, they were a graphics card company to most people.
Exactly. But when the actual tangible AI demand for GPUs materialized at scale, the market was forced to reprice NVIDIA entirely. The old valuation framework was discarded. It was no longer evaluated as a hardware cyclical. It was repriced as an infrastructure monopoly, a utility company for the new digital age.
And you think that's happening now with the hyperscalers?
Yes. The lesson for today's market is highly relevant. Platforms that are successfully building the picks and shovels of the next massive technological platform shift will consistently look expensive for far longer than conventional risk models allow. If you trim your winners just because the chart looks tired, you miss the fundamental multiple expansion that occurs when the Capex converts into monopoly pricing power.
Okay, but
We saw the exact same dynamic during the launch of ChatGPT on November 30, 2022. That single event did not just introduce a new product, it completely transformed the market's long-term earnings expectations for the entire megacap complex. It proved that when a platform shift becomes a tangible reality, the leadership, the user adoption, and the economic rents accrue overwhelmingly to the incumbents who already own the distribution rails. Microsoft integrated it into their ecosystem seamlessly.
That was a specific catalyst, though.
It was, but furthermore, there is a rigorous behavioral and academic argument for holding through this specific 11 to 27% drawdown. The equity risk premium exists precisely because investors are compensated for tolerating systemic and idiosyncratic risk over time. Over-insuring against every technical drawdown actively transfers wealth from equity holders to option sellers.
I see where you're going with this.
If you are constantly buying expensive puts, the time decay, the theta, will bleed your portfolio dry. Therefore, if investors cannot stomach the naked volatility, they should use targeted collars, put spreads, or long-dated index puts to stay in the trade, rather than capitulating and panic selling a secular winner at the exact bottom of a technical dip.
that is a compelling narrative, but I must push back forcefully on the direct translation of that historical analogy to our current dilemma in March 2026. NVIDIA, in the early deep learning wave, was undergoing a fundamental repricing of an entirely new infrastructure layer. The market was discovering a new utility. Today, these megacaps are already priced as mature, undisputed monopolies. The multiple expansion has already occurred. You cannot expect a second structural repricing on top of a $3 trillion market cap.
The Capex suggests there is a new layer, though.
You make, the idea that over-insuring transfers wealth and we should just hold through the noise, is perfectly fine if we are discussing a 2% or 3% position in a highly diversified multi-asset portfolio. In that scenario, yes, except the volatility.
Right.
But it is mathematically fatal for a 15% or 20% position. A 25% drawdown on a 20% position shaves 500 basis points off the aggregate fund performance. You cannot recover from that mathematically in a single cycle.
500 basis points is a massive hit.
It ends a career. And that stark distinction between business quality and position structure leads us directly to the structural bear case. We need to clearly define why strong businesses can and currently do function as badly structured positions. We have to dissect the unstable positioning dynamics currently at play. Go on. We are watching a severe structural unwind risk develop in real time. Hedge funds and fast money quantitative accounts are actively trimming their North American megacap exposure because the momentum signals have failed. But at the exact same time, slower-moving institutional capital, pension funds, sovereign wealth, is still treating U.S. megacap tech as a relative safe haven against geopolitical volatility and emerging market weakness.
It's a clash of time horizons.
Exactly. And that specific combination is structurally toxic. When an asset is overwhelmingly crowded and a massive portion of the holder base is there for emotional security rather than pure fundamental conviction in the $132 billion Capex spend, the exits become violently correlated the moment confidence actually cracks. If the safe haven proves unsafe, the liquidation is indiscriminate.
I acknowledge the crowding.
It is visible in every prime brokerage report, but crowding alone does not break a foundational business model. It just creates volatility.
It does not break the business model, but the operational asymmetry does. And this is where the math becomes truly terrifying for a concentrated holder. Let's detail the exact cybersecurity mismatch currently embedded in these valuations. We are looking at estimated cybersecurity spending for select mega-cap firms ranging from $1.2 billion to $3.0 billion annually.
Which sounds like a lot of money.
It sounds like a large absolute number, but it represents roughly 0.4% to 1.0% of their total revenue. These minimal defensive budgets are tasked with defending market capitalizations ranging from $2.0 trillion to $3.0 trillion. Let that sink in.
It's a massive discrepancy.
It is a massive, unbridgeable mismatch. A fraction of 1% of revenue is defending an enterprise whose entire multi-trillion-dollar market value rests on uninterrupted systemic trust in its digital infrastructure. One major breach, one structural failure in an AI model's integrity, and that $3 trillion valuation is entirely exposed.
But that's a hypothetical tail risk.
Is it? If you want historical precedent for great fundamentals failing to protect concentrated portfolios, look at Cisco after the March 2000 peak. The market memory here is crucial. Cisco was not a speculative fraud like Pets.com. It was the actual physical backbone of the internet age. Its routing technology was real, its necessity to global telecommunications was undeniable, they were generating real cash.
They were.
Yet, concentrated holders of Cisco suffered an 85% or greater decline, falling from over $80 a share in March 2000 to under $10 by late 2002. Great fundamentals did absolutely nothing to immunize portfolios against an extreme drawdown when the market regime shifted and the capital expenditure cycle in telecommunications paused. The business survived and remained dominant, but the equity holders were annihilated.
I hear you.
And to address your earlier point about using collars and put spreads to magically hold through the noise, we must be brutally honest about the mechanics of these hedges. Hedges are not free. Long puts decay relentlessly. Theta is a constant drag on your daily P&L.
Sure.
VIX exposure suffers from severe roll drag. For those unfamiliar with the mechanics, VIX futures are typically in contango, meaning longer-dated contracts are more expensive than near-term ones. Every time you roll your protection forward, you are locking in a persistent structural loss. You bleed capital every single month waiting for a crash.
But put spreads can mitigate that premium cost.
No, put spreads artificially cap the exact protection you desperately need. If you buy a 10% out-of-the-money put and sell a 20% out-of-the-money put to finance it, your protection stops entirely if the stock drops 25%. In a true nonlinear accident, a put spread leaves you exposed at the exact moment the bottom falls out. You are bleeding operational capital to protect a massive position you should simply be reducing.
Hold on, I need to jump in here because that Cisco comparison is highly problematic. Are you seriously comparing 2026 AI incumbents to 2000 Cisco? That feels frankly intellectually lazy.
Lazy? Explain.
Let's look at the mechanics of the Cisco collapse. Cisco was trading at astronomical price-to-earnings multiples, well over 100 times forward earnings, with cash flows that could not possibly support the valuation once the telecom Capex dried up because their customers went bankrupt.
The dot-com bust, yes.
Exactly. Today's mega caps are generating hundreds of billions in actual recurring free cash flow from diversified enterprise and consumer software subscriptions. Microsoft's customers are not going bankrupt. They are the Fortune 500. Furthermore, the execution risk you mentioned regarding the AI build-out, chip scarcity, data center permitting delays, massive power grid constraints, the market is acutely aware of these. They are known quantities. Sophisticated quantitative models have already priced those exact friction points into the 11% to 27% drawdown we are currently observing. The risk is priced.
I agree entirely that Cisco's free cash flow profile and customer concentration were different than Apple's or Microsoft today. I am not arguing that Microsoft is trading at 100 times revenue, but the structural risk to the equity holder is identical.
How is it identical?
The risk is not a lack of current cash flow. The risk is the concentration of massive amounts of capital in a single correlated failure domain. Which brings us perfectly to the architecture of this risk. We need to visualize exactly how this fragility operates. We need to explore the concept of the digital monoculture.
Okay, the monoculture analogy. Go ahead.
Think of agronomy. Let's build this analogy carefully. Mega-cap tech operates exactly like a vast agricultural region that has been planted with a single, genetically identical crop. In stable periods, a monoculture is brilliant capital allocation. It optimizes yield, it creates massive scale efficiencies in harvesting, and it drives down unit costs. It looks like perfectly rational optimization.
Because it works.
Yes, until it doesn't. It inherently creates a shared systemic failure domain. Because there is zero genetic diversity, the moment a specific pathogen or pest evolves that can breach that specific crop's defenses, the entire regional harvest collapses simultaneously. The efficiency of the system is the exact mechanism of its destruction. This is exactly what we have built in modern digital infrastructure. Cloud computing, foundational AI tooling, enterprise data storage, it is all centralized in a handful of identical architectures run by 3 or 4 firms. A vulnerability in one foundational model or a breach in one hyperscaler's hypervisor layer acts exactly like that pathogen.
I understand the agronomy metaphor, but I think it overstates the fragility. If AWS experiences an issue, Azure does not automatically fail. They are distinct architectures. Let me deploy the movie studio analogy to defend the Capex cycle and the current price action we are seeing.
All right.
The current weakness in the technicals, those 4 out of 6 closed 10 signals, the 20% drawdowns, is equivalent to a temporary dip in quarterly box office receipts for a legendary movie studio. Yes, the current quarter looks weak. Analysts are downgrading the near-term earnings. But the studio is already aggressively filming an incredibly expensive, highly anticipated sequel. The $91 billion Alphabet is spending is the production budget for that sequel. The enterprise demand for generative AI is guaranteed. The sequel will make money. Therefore, the fundamental value of the equity is simply deferred, not destroyed. You hold the stock because you know the blockbuster is coming next year.
That is a fundamentally flawed way to look at systemic risk. The sequel's quality, the budget, the anticipated box office, all of it is completely irrelevant if the theaters all burn down simultaneously before the movie is released.
That's a bit dramatic.
That is what the digital monoculture represents. Let me give you another way to look at it. Critical infrastructure. Judging the safety of these mega caps solely by their $132 billion Capex budgets and historical chart patterns is like judging a skyscraper by its highly expensive, beautiful paint job and the architect's magnificent blueprints, while completely ignoring the termites that are actively eating the foundation. The cybersecurity mismatch is the termite in the foundation.
I see.
Or consider the insurance economics we just debated. Buying continuous option protection for a 20% position is buying an insurance policy that, over a multi-year horizon, will cost you mathematically more in premiums and roll drag than the total loss it is designed to prevent. And finally, look at defense strategy and game theory. There is a concept we call the digital shelling point of fear.
The shelling point.
Yes. A shelling point is a solution that people tend to choose by default in the absence of communication. In this concentrated market, there is a latent, shared understanding among institutional managers that if a true, systemic cyber event occurs, everyone will instinctively rush for the exact same narrow exit. The liquidity will vanish instantly.
The idea of a digital shelling point where all liquidity evaporates is a stark image. But again, you are assuming a catastrophic failure that destroys the foundation. What exactly does that look like?
That shared failure domain naturally introduces the most critical unpriced risk in the market today. This is the wild card. We are dealing with companies that are simply too infrastructural to fail gracefully. We define this as the discontinuous trust shock.
Discontinuous trust shock.
Yes. Market participants are highly accustomed to equities repricing in neat, continuous, easily digestible quarterly increments. A company misses earnings by 3 cents, the stock drops 4%, and it finds a new equilibrium. That is a graceful failure. But mega-cap tech is no longer just selling software. They are the operating system of global commerce, healthcare, logistics, and finance, which makes them vital. Vital, but catastrophic when they stumble. When they fail, it is not an earnings miss, a trust shock, such as a prolonged multi-region cloud outage, A systemic failure in AI model integrity, where the model is poisoned and outputs malicious code to enterprise clients, or an operational breach that actually physically impairs infrastructure rather than just leaking credit card data, causes the market to gap. It is a non-linear event. The stock does not trade down from $150 to $149 to $148. It closes at $150 and opens the next morning at $110.
That's the gap down risk.
Exactly. Let us return to the mechanics of the December 7, 2021 AWS outage to illustrate this. That was not a highly sophisticated, malicious nation-state cyber attack. It was a routine operational failure, an automated scaling error. Yet it proved definitively that modern digital life rests on terrifyingly narrow choke points. Now, scale that up. Imagine a malicious, AI-linked disruption targeting those exact same choke points, a self-replicating ransomware worm engineered by a generative model. The repricing of the equity would be violent and instantaneous.
And you're saying standard hedges won't catch this.
This is exactly where traditional portfolio hedging architectures completely fail. Let's unpack the mechanics of why. Broad index puts, like S&P 500 puts, will not protect you fully if the failure is entirely stock-specific. This is called basis risk.
Right, because the S&P has other sectors.
Exactly. If Amazon gaps down 30% due to an AWS structural breach, but the rest of the economy, energy, financials, industrials, hold steady because they are seen as safe havens, the S&P 500 might only drop 2%. Your S&P puts expire worthless, while your massive Amazon position burns to the ground.
That is a very real mechanical issue.
Furthermore, relying on thematic cybersecurity ETFs will fail. Why? Because in a true discontinuous gap down caused by a cyber event, the market will not immediately discern between the breached company and the cybersecurity vendors. The entire digital risk complex will correlate to one. The cyber ETF will plummet right alongside the hyperscaler. Your carefully modeled, theoretically sound hedges will break down exactly when you need them.
Because you are asking investors and fiduciaries to model the mathematically unmodelable. How can a rational portfolio manager accurately price a discontinuous trust shock? If it is truly a gap risk, an unforeseen left-tail event with unknown timing and unknown severity, isn't any attempt to systematically trade around it just highly sophisticated guessing? You are asking managers to pay massive premiums for a phantom risk that may never materialize.
That is exactly the point, and it highlights the fundamental misunderstanding of risk management in this specific regime. You do not trade around it. You cannot time a gap down. You do not trade around a discontinuous gap. You size your positions to survive it. You must alter the structural architecture of the portfolio in peacetime before the shock occurs.
Recognizing that severe tension, that the bullish case is highly likely correct about the fundamental destination of AI dominance, but the bearish case is accurately identifying the catastrophic, nonlinear risks of the journey, we must move to synthesize a definitive portfolio strategy. We have to reconcile the distribution of outcomes for the capital we manage.
We have to give them a path forward.
Exactly. If we map the realities we have debated, my position, the bullish case, owns the median outcome. The secular AI compounding story over a 5 to 10-year horizon remains deeply intact. The hyperscalers will absolutely dominate the next computing cycle. The $300 billion in Capex will build a moat that no competitor can cross. If you simply hold, the median probability is that you will compound wealth.
And my position, the bearish case, owns the shape of the downside. We acknowledge the high probability of the median outcome, but we are mandating that managers optimize for the left tail. Because those left tail outcomes are now exponentially more violent, highly correlated, and operationally driven than standard growth stock valuation frameworks allow for.
This leads us jointly to the critical conceptual breakthrough of this briefing. We have debated puts, callers, and VIX futures, but the mathematical truth of the current regime is this: cash is the cleanest hedge.
It is the only perfect hedge.
Let me explain exactly why trimming an oversized position to raise cash is superior to complex derivatives. It creates a hedge that is entirely free of implied volatility forecasting. You don't have to guess if the options are overpriced. It is free of VIX timing and the rule drag we discussed earlier,
It is free of path dependency. It doesn't matter if the stock crashes tomorrow or bleeds out over 6 months. It completely eliminates basis risk. It simply, elegantly reduces the gross capital at risk.
Exactly. That is the only rational response to a monoculture risk. We operate on a strict, unyielding strategic hierarchy of action. Step 1. If the position is too large for your risk tolerance in a discontinuous gap scenario, you reduce it. You sell the shares.
Just sell it.
Step 2. If and only if embedded tax constraints or strict institutional mandates mean you absolutely cannot reduce the physical equity, only then do you hedge it with derivatives. Step 3. If the position is already sized moderately and your time horizon is long enough to absorb a multi-year drawdown, you accept the volatility and do nothing. But you never buy expensive protection for a massive position you are legally allowed to trim.
It's a clean hierarchy.
Reflect once more on the Amazon synthesis in late 2021. The structural excellence of AWS coexisted simultaneously with a massive systemic vulnerability, the outage, and an extreme equity drawdown of $140 billion. They were all mathematically true at the exact same time. It was a great business, a vulnerable system, and a terrible stock. In that environment, trimming the concentration prior to the event was the only mathematically sound defense.
So we must now translate this strategic framework into exact, actionable execution. We are moving to the final mandate of this briefing. What this means for your portfolio, down to the exact arithmetic. This is the execution briefing. We will walk through every portfolio recommendation with absolute precision, utilizing the exact numbers mandated by the structural risk models we have built.
Let's lay out the rules.
Number 1. Trim oversized tech. If a single megacap holding exceeds 15% of your total portfolio value, you must actively reduce it. We do not care about the long-term conviction. Remember the context we established. 4 of 6 trend signals are closed, and the basket is 11% to 27% below its all-time highs. Momentum is at geometric order 0. Do not buy expensive option protection for a position that is simply too large. Sell the equity, raise the cash.
Number 2, stock level puts. If you are restricted from trimming, use 6-month protective puts strictly 10 to 15% out of the money. Let's be clear on the mechanics. These are deployed solely for true concentration risk. They are designed as catastrophe insurance against that idiosyncratic Cisco-style collapse or a specific AI trust shock. They are not designed to protect against a standard 5% market correction. You accept the minor drawdowns to lower the premium cost.
Number 3, portfolio-level hedges. For broader systemic shocks, where the failure of one megacap drags down the entire digital economy, utilize QQQ or S&P 500 index puts, or modest VIX call and futures exposure, but keep the sizing small due to the roll drag and basis risk we outlined.
Number 4, collars. Deploy these only when embedded tax constraints explicitly block you from selling the underlying equity. By selling an out-of-the-money call to finance the purchase of an out-of-the-money put, you finance your downside protection by artificially capping your upside capture. It is a necessary evil for taxable accounts with massive embedded gains.
Number 5, diversifiers versus hedges. Allocate a strict 3% allocation to long-duration treasuries. Utilize gold for classic risk-off or geopolitical stress events. But be explicitly aware of the correlation matrix. These are diversifiers. They are not one-to-one hedges for a mega-cap tech unwind. If Microsoft gaps down 30% due to an AI model failure, gold is not going to gap up 30% to perfectly offset your loss.
Number 6, avoid thematic hedges. You can allocate a 1% allocation to cybersecurity ETFs, such as BUG or CIBR, as a general resilience overlay. It captures the secular spending trend. But do not trick yourself into thinking this is a clean hedge against the digital monoculture collapse. In a true panic, BUG and CIBR remain highly correlated to the broader digital risk complex. They will go down with the ship.
Number 7, scale hedges to risk. This is the precise formula that must be coded into the risk models. For every 10% allocation to mega-cap tech in your portfolio, you allocate exactly 1% in cybersecurity exposure and 0.5% in long-dated QQ puts 15% to 20% out of the money with 12 to 18 months to expiry. That defines the baseline peacetime architecture.
And crucially, you only trigger conditional increases to those baseline hedges under two highly specific scenarios. You scale up the protection if global ransomware payments rise by more than 50% year over year, or a Tier 1 tech firm suffers a 72-plus AI-related outage that results in more than $10 billion of measurable revenue impact. Those are the tripwires indicating the regime is fundamentally fractured.
I have to dissect those exact trigger thresholds before we close. A 72-hour outage with a $10 billion impact? Let's walk through the mechanics of that. If a Tier 1 hyperscaler like AWS or Azure actually goes dark for 3 continuous days, the cascading effect on global commerce would be catastrophic. The market will gap down 20% before the second day even finishes. How can a portfolio manager possibly price or scale options effectively during an event of that magnitude? The implied volatility skew would be astronomical. The puts would be instantly unaffordable.
That is exactly the point. You cannot buy the roof while the house is actively on fire. The structural sizing, the mandatory 15% trim threshold, the baseline 0.5% allocation in long-dated QQQ puts must be fully executed and sitting in the portfolio before the discontinuous trust shock occurs. The triggers, the 72-hour outage or the ransomware spike, are strictly for scaling secondary emergency protection if the entire digital ecosystem fractures. But the foundational defense must be established right now, in peacetime, while the volatility is still somewhat measurable.
Bringing this all together into a final thesis for the capital we deploy. The bottom line is this: mega-cap tech undoubtedly retains the absolute best secular growth profile in public markets. The fundamentals are historic. However, market concentration, passive crowding, and severe digital fragility are now dangerously entangled. The fundamental decision for sophisticated investors in March 2026 is no longer a debate about whether AI's transformative power is real. It is. The mandate is entirely about whether your specific position sizing can survive the violent volatility when the pricing leadership inevitably cracks.
The real opposite of hedging is not courage, it is position sizing.
This is the research desk officially signing off.